All right, we're starting the new year looking way ahead. There's this fascinating analysis floating around that suggests 2026 could be an absolutely monumental year for the markets. So today, we're going to break down exactly why. Let's dive in.
So here's the big question, the one we're all thinking about. Is 2026 really set for a historic market rally? The forecast we're digging into points to a massive rally for pretty much all hard assets. We're talking the S&P 500, Bitcoin, gold, silver, the whole lot. So what's driving this incredibly optimistic view? Let's break it down.
Okay, so the whole thing really hinges on this idea of, well, call it an unofficial global growth pact. The argument is that the world's two biggest economies, the US and China, find themselves in a pretty rare spot where, for once, their main goals are totally in sync. And if you look at their motivations, it makes a lot of sense. For the US, it's all about handling this huge mountain of public debt. And really, the only way to do that without a lot of pain is to grow the economy fast. And over in China, they're dealing with some real economic headwinds, so for them, pumping up GDP is an absolute must. So you see the shared goal here? Both of these economic giants have every reason to slam on the gas pedal at the exact same time. And look, this isn't some random guess just pulled out of thin air. The whole idea is that the table for this big economic party in 2026 was actually set back in 2025. The policies, the conditions, it was all put in place deliberately to create a major expansion. So let's dig into how this is all supposed to work, and we'll start with what's happening in the US. All right, so if we're talking about a global expansion, we have to look at the main engine room, right? So let's zero in on the United States and check out the specific levers they're planning to pull to get this whole thing fired up. So the strategy here isn't just one thing. It's really a four-pronged attack. You've got direct spending straight from the Treasury, you've got tax cuts and rebates to get cash into people's hands, then there's financial deregulation to get banks lending. And fourth, and this is a big one, you're tapping into all that private investment in AI, which, as we know, creates its own powerful shockwaves through the economy. Okay, let's start with Treasury spending. So get this, the US Treasury is sitting on an account at the Fed with something like $900 billion. And here's the kicker. That money can be injected directly into the real economy. We're talking businesses, households. It completely bypasses the banks, so the impact is immediate. All right, next up, financial deregulation. The idea is to ease up on the capital requirements for banks. The amount of cash they have to keep on hand. That alone is expected to free up about $210 billion. Now, I know that number might not sound as big as the last one, but trust me, it's a massive catalyst. Because of the way bank lending works, that $210 billion could actually unlock somewhere between $3 and $5 trillion in new credit. That's a huge deal. And then you've got the private sector jumping in. We're looking at AI companies alone planning to invest a cool $120 billion. And that's not just money in a vacuum. It creates this incredible multiplier effect. Think about it. It drives demand for semiconductors, copper, energy, you name it. It's a tide that lifts a whole lot of boats. Okay, so you've got the government's fiscal engine firing on all cylinders. But to really turn this into a boom, you need to hit the accelerator, right? Well, in this playbook, the Federal Reserve is the one with its foot on the gas, ready to unleash a huge wave of liquidity. You see, with the labor market showing signs of weakness and inflation finally coming down, the Fed has the green light to act. And what does that mean? Well, for starters, lowering interest rates. But also bringing back quantitative easing, where the Fed essentially prints money to buy up bonds to the tune of $40 billion a month. And on top of that, they'll be pumping cash into the banking system just to make sure everything keeps running smoothly. And if you needed any proof that they're serious about this, get this. On the very last day of last year, the Fed injected $70 billion into the repo market. That's that critical plumbing of the financial system where banks lend to each other overnight. I mean, that's the biggest single shot of cash they've done since the COVID crisis. It's a massive signal that they are ready and willing to keep the whole system swimming in cash. All right, so let's recap. We've got a fire hose of fiscal stimulus from the government, and at the same time, a tidal wave of monetary stimulus from the Fed. So what's the end result? What's the payoff? Let's connect the dots and see what this powerful cocktail could mean for the markets. And just as importantly, let's talk about the big warning that comes with it. So, for the stock market, the target is pretty wild. The S&P 500 hitting 7,800 by the end of the year. And that's not just a number pulled out of a hat. It's based on the idea that corporate profits will grow by at least 10% thanks to this booming economy. And hey, it's not just going to be stocks. When there's this much cash flooding the system, you can bet that hard assets are going to do well too. For Bitcoin, the target is a huge milestone, $100,000. And the logic here is pretty straightforward, right? The more dollars you print, the more people want to own something that you can't print, something with a fixed supply. Okay, but here comes the really important part. You have to listen to this. This journey to these high-flying targets, it's not going to be a smooth, straight line. Not at all. Whenever a prediction starts to look this obvious to everyone, the market just has this nasty habit of trying to shake everyone out. So you should absolutely expect some serious volatility along the way. Big swings. It's like that old saying, right? Volatility is simply the price you have to pay for a ticket to the show. And all of this leads us to the final and maybe the most important question of all. When you pump this much government money and this much central bank liquidity into the system all at once, are you actually creating real, sustainable, healthy growth? Or are you just borrowing growth from the future and setting us all up for an even bigger, nastier crash down the line? That, my friends, is the billion or maybe even trillion-dollar question we're all left with.